very warm welcome to this weekend preview with me, Aaron Hill, the Chief Market Analyst here at FP Markets. Now, September has arrived, and with it comes one of the most anticipated weeks of economic data, I believe, that we've seen in a number of weeks. While there are multiple data points to consider, there's no question that Friday's payrolls report for August is top of mind for market participants. So as you can see here, for the August non-farm payrolls print, markets or economists are expecting that we will see another subdued report of 75,000 new payrolls to be added to the economy in August. And this is slightly higher than the 73,000 that was added in July. Now, in terms of private payrolls, we're also looking at another subdued report of 75,000. This is down from 83,000 in July. Now, in terms of the unemployment rate, as you can see here, we are expected to tick higher to 4.3%. This is up from 4.2%. The estimate range is between 4.3%, a high of 4.3%, and a low of 4.1%. I do want to add, and this is something I should have said, that for the main NFP print, we do have a maximum and minimum estimate range, or the forecast distribution. We currently have a high of 110,000 and a low of 0. 110,000 is courtesy of, if memory serves me correct, Deutsche Bank, and the 0 print is courtesy of Scotiabank. So just bear that in mind. Finally, in terms of the wages data, month over month, we are expected to remain steady at 0.3%. We do have an estimate range of 0.4% and 0.2%. Year over year, we are actually expected to see a small decline to 3.7%, down from 3.9%. Now, the Fed finds itself, as I'm sure you're all aware, the Fed finds itself in a particularly challenging situation, to quote Fed Chair Jerome Powell, a challenging situation right now. And they're caught between conflicting economic signals that makes the jobs report absolutely critical to determine policy direction. So on the inflation front, we have seen some relatively concerning prints for policymakers. Price pressures have showed renewed strength to the upside. So for the month of July, you can see that the core PCE data came in at 2.9%. This was up from 2.8%. PCE headline, off memory, remained steady at 2.6%. The US core CPI data actually turned higher to 3.1%, and this was up from 2.9%. Now, the headline US CPI print also remained steady at 2.7%. Now, I haven't attached it to this chart, but the PPI inflation, the wholesale inflation for the US also saw marked upside prints for the month of July, with the year-over-year measures considerably north of 3%. Look, the mixed PCE data, so headline remaining at 2.6% and the core PCE at 2.9%, I don't think was enough. It clearly wasn't enough for the market. I don't think it's enough to sway the existing divisions, within the Fed currently. So up on the chart right now, the growth picture shows a slightly different narrative. So economic expansion has remained pretty much robust, with GDP revisions for Q2 25 showing a stronger than expected scenario. So as you can see, according to the second estimate, real US GDP grew at an annualized rate of 3.3%. And this is up from the first estimate of for Q2 25 of 3%. And it also the second estimate also surpassed the 3.1% median forecast that from economists, signifying that the economy is is in better health than previously feared. However, I do want to add that growth in the first half of this year is certainly slower than in previous years, as you can probably tell from this chart. The point is, right now we have real GDP growing at a reasonably healthy clip. We also have inflation that remains persistently higher than the Fed's 2% inflation target. And the labour market has notably softened. And this is where things become rather tricky. It has clearly been the labour market that has caught the attention of the Fed, including Fed Chair Jerome Powell. You recall from his latest speech at Jackson Hole, he did mention that employment risks have increased. The previous month's US non-farm payrolls data was not really just about job creation, but it was also more about those significant downside revisions that were seen in May and June. July, as I've already mentioned, July's employment report showed a mere 73,000 jobs were created, were added to the US workforce, a figure that fell down from, I think it was 147,000 in June. And this marks a notable deceleration. It was also the first softer than expected payroll print since earlier this year. I think it was March. The point really that I wanted to reinforce today is that you will recall that it was the chunky downside revisions that raised a lot of eyebrows for market participants with the May and June revisions here, totaling, I think it was 258,000 payrolls wiped from the data. Accompanying these meager revisions was the 3-month average, showing that an average of 35,000 new payrolls were added to the US economy. And this really reflects a slowdown, a considerably slower pace in the hiring in the US. So on the back of these July figures, you may also recall that US President Trump fired the commissioner for the BLS on the back of this data, claiming that the data was rigged, and it was rigged in order to make not only himself look bad, but also the Republicans look bad. But look, as far as I understand, correct me if I'm wrong, but the BLS commissioner does not have any influence on the final outcome of that data. So all Trump has done really by firing the BLS commissioner is, in my opinion, undermined the credibility in what is a very, very important economic data print that us as traders look at every single month. Look, in terms of, I mean, if you check his social media post, he said that the data was there to make himself and the Republicans look bad. All he's done, in my opinion, here, and I have no political bias whatsoever, he's made himself look bad by firing the BLS commissioner, in my opinion. What the data has done is it has prompted several Fed officials to open the door, shall we say, to potential policy easing, with clear indications that September is possibly on the table, which included Fed Chair Jerome Powell in his latest speech, which he did openly show that he is. I don't want to say he was incredibly dovish, because he wasn't, but he did have he did offer a dovish tone, shall we say, that does essentially open the door to a more dovish policy. The challenge now is determining whether the recent labour data or the labour market weakness represents either a temporary cooling of the labour market, or whether it's let me repeat that actually. So the challenge really now is for the Fed is determining whether the recent labor market weakness represents a cooling or the beginning of a more significant deterioration in the labor market data. If the Fed acts too aggressively at this point, they risk igniting inflation, which is already, as I've already shown, showing an upside bias. But if they wait too long, they're then behind the curve on that labor market weakness. And, they don't really want to be behind the curve again. So yes, something I do want to point out as well is the unemployment rate. So the unemployment rate has, as you can see here, circled around 4.2% since I think it was June 2024, mid 2024. And we've not budged from around 4.2% in all of that time. So this suggests that while fewer jobs are being created through that non-farm payrolls print, widespread layoffs or significant labor market distress are not occurring at this point. And this also aligns with the US initial jobless claims and comments from recent Fed speakers, which highlighted that the US is in a low hire, low fire mode. And as you can see here, this really is shown on the initial jobless claims data here. So we are, for the initial jobless claims data, we are marginally off lows, but unemployment claims are not really signaling any red flags at the moment. Let me just go out to 20. There we go, 20 years. So if you look at 09 or 08, the 08 financial crisis, I mean, the US initial jobless claims were up to around 650,000. For the COVID-19 pandemic, I mean, around the high was at 2.9 million unemployment claims. Right now, we're at 229,000. So it's really not showing any red flags, in my opinion, or anything to cause concern. It's certainly not suggesting that there are widespread layoffs right now. And continuing jobless claims, this red line is also reinforcing that picture, trending higher since bottoming around 2022 and indicating that it is proving more difficult to find a job, hence that low hire mode. So if we just come back to that all-important US payrolls data. So look, if the jobs report confirms market expectations, which let me just go over the market expectations just really quickly. So for the market expectations for the Fed right now, just bear with me, guys, while this loads up. There we go. So right now we are fully pricing in that the Fed is going to cut. Well, we're not. The markets are fully pricing in that the Fed will cut rates by 25 basis points or at the September meeting. As you can see, it's assigning 100% chance now. So we're fully priced in with. I am not sure what's gone on there. I'm not sure. It's not 162 basis points. Just bear with me there, guys. I'll have to come back to that. I think there's an issue with that, but it shows we are fully pricing in I think that's an issue. Just bear with me. Yeah, it's still showing that. I think that's incorrect. But it is showing, look, overall, we are showing that we are fully pricing in markets are fully pricing in a 25 basis point cut. So that's the market expectations. And if we do see a jobs report that confirms this, expectations of continued softening, the dollar's decline could accelerate. And I will touch on the chart very shortly. Particularly if the data is weak enough to increase expectations beyond September's meeting. So I'm looking at the data right now. If we come in minus for the non-farm payrolls, remember the lowest print is at 0. If we come in minus, so we actually show that jobs were lost, plus we see a tick higher in the unemployment rate to preferably above 4.3%. So if we hit that 4.4% mark, we will see strong downside moves in the US dollar, in US Treasury yields as markets reassess the Fed rate cut pricing. If we see stronger than expected report, and this could potentially lead to a sharp dollar strength. So if we see the print come in at 110 or above, this could see sharp dollar upside, and obviously yields would rally on the back of that as the markets reassess the Fed's easing path. Now, for the equity market, this is a bit of a different it's a bit more of a tricky situation. So the ideal scenario for stocks right now would be for modest labor market softening that justifies Fed easing without causing recession concerns. And this would also maintain that soft narrative, that soft landing narrative that has supported risk markets. Look, however, if the employment data does deteriorate significantly, equity markets they could face a difficult choice between essentially celebrating the additional rate cuts or worrying about underlying economic health. If you look back in history, this really suggests that when the labor market weakens significantly or rapidly, the negative implications often outweigh the benefits of monetary easing. Now, if I switch to the US dollar index right now, you will see that we are down on the day. We're down by about 0.3% right now. But technically, and we're breaking below this this range that we've been in on the daily time frame between support of 97.72 and 98.57 resistance on the daily time frame. You can also see that 50-day simple moving average circling in between that range as well. I have been watching this range closely, and I think it was in the weekend preview, I do anticipate a breakout to the downside, purely on the back of this technical picture we're seeing right now, and the Fed is expected to ease policy. So on the monthly chart here on the far left, you can see that price rejected resistance at 99.67 back last month, and we still have room, albeit not a great deal of room, but we still have room to reach that channel support, which has already been tested and failed to overcome this resistance. So given we have rebounded from this channel support, failed to find acceptance above this resistance at 99.67, this really places this channel support in a negative light and could be breached if tested. Now, this all adds to that bearish vibe from technically. So on the daily time frame, given that consolidation, given the clear downtrend right now, given that death cross where the 50-day SMA crosses below that 200-day SMA, everything points to the downside for the US dollar. And this is why I anticipated a breakout to the downside, which you can see is occurring as we are filming. So with a breakout to the downside and room to move to at least around the 97 handle, we could see it further moves to the downside on the back of that. Now, I am watching this support on the daily time frame at 95.67 closely. This is beyond those lows of that were formed in July and the lows formed in July. So that low here and that higher low at this point here around 97.11. But ultimately, I do believe that we will continue to this support at 95.67 on the daily time frame, because I believe we will break this channel support. And if you look closely, this daily support is, if you look at on the monthly chart there where the crosshairs are, that daily support is sitting just between that channel support and a 100% projection ratio. Now, the 100% projection ratio here at 94.96 is actually the termination point for that AB equals CD pattern, which is the basics of all harmonics, harmonic patterns. So look, I do see in the medium term, I see downside for the dollar, but I do see some strong support around that, around between the 95 area, around the 95 area, I do see some strong support for the dollar. But overall, a breakout to the downside could send strong, a breakout to the downside could trigger further breakout selling, and will be emphasized if data, US employment data does come in much weaker than expected. Like I spoke about before, if we do see that non-farm payrolls print come in negative and we see the unemployment rate tick higher to 4.4%, then we could see a strong move to the downside, and that daily support at 95.67 potentially tested. So the key for investors right now is given that the risk heading into that non-farm payrolls print is essentially maintaining flexibility and avoiding overcommitment to directional views, I believe, given the binary nature of potential outcomes here for this Labour data. It could go either way, in my opinion. Risk management should take precedence over profit maximization in such an uncertain environment. Whatever the outcome of this US payrolls data is, this will help set the tone for markets, and it will I believe through the remainder of this month and potentially into Q4 of this year. So it's a big data print, and one that could generate sizable moves and good opportunities to trade these risk events. So that's the outlook for the week ahead. Stay flexible, manage risk carefully, and prepare for potentially significant market moves around that Friday's employment data. Thank you very much for listening. Have a great week ahead.